Greetings, let us discuss the future of the automobile sector. It's no secret that as EV adoption approaches, legacy automakers like Ford and GM are having difficulty. You may have seen headlines stating that Tesla has outpaced Ford in terms of EV adoption and that the CEO is surprised by how quickly EVs are being adopted. Many of us were shocked to learn that renowned money manager Cathie Wood, who has always supported Tesla, had drastically changed her opinion on long-standing automaker GM. Unexpectedly, GM has received funding from Cathie Wood's ARK Investment Management. The success or failure of Wood's new attitude on GM is certain to have a significant impact on industry perceptions for years to come, given Wood's shift in stance in GM's recent troubles. In this video, we'll examine the significance of Wood's prediction, its implications for the larger car industry, and the context of Tesla's recent price reductions. However, hit the like and subscribe buttons before we continue. First of all, remember to use the notification bell. According to Wood, by 2025, Tesla's shares might reach an incredible $3,000. In addition to being astounding, this prediction sheds insight on the difficulties that established automakers like Ford and GM may encounter in the years to come as they attempt to compete with younger, more creative businesses. This forecast stands in sharp contrast to some analysts' more optimistic assessments, such Morningstar's David Witston, who believes that GM stock has a fair value of $68. Jim Farley, the CEO of Ford, acknowledged that the business had lagged behind in its adoption of electric vehicles in a recent interview with Sandy Munro. Farley stated that he wished to discuss Henry Ford's success in winning the globe by producing cars that were cheap for all people, and how Ford is currently attempting to follow a similar path in order to stay ahead of the market trends. Farley emphasized the need to offer products at a range of pricing ranges, not only high-end ones in China, where digital EV products are becoming more and more popular. In the 1970s, Farley noted GM's market share fell precipitously from 60% to almost nothing, while Toyota, which had no market share before, shot to the top by building automobiles that consumers desired. Thus, Farley believes that the winning approach is to take the market as a whole rather than just a segment of it into account. However, Ford's company in Europe was struggling and they realized their strength was in the pickup truck industry. Ford had thought they could compete in the sedan and hatchback market. They concentrate on areas where they have a deep understanding of the client with the Maverick to make sure their innovations are well received. Farley acknowledged that with just 6.2% of the EV market share, Ford is now in second place, right behind Tesla. He did, however, note that Ford should be pleased with their 95 electric advancements. Unexpectedly, Wood's ARK Investment Management has acquired more than 150,000 shares of General Motors for its autonomous technology and robotics fund, ARKQ. Despite the fact that some people may not believe Farley and Ford, Wood has previously questioned traditional automakers' capacity to stay up with innovation, so this purchase marks a substantial change in her viewpoint. Following a meeting between Wood's team and General Motors CEO Mary Barra to go over the company's plans for electric vehicles, this action was taken. Wood stated that ARK was thinking about investing in GM and was keeping an open mind about it in an interview with Yahoo Finance. The choice to invest in General Motors is noteworthy, because it demonstrates that even a well-known stock picker who is best recognized for her wagers on swiftly expanding technology businesses is seeing the possibilities in legacy manufacturers and the quickly changing auto sector. It also shows that GM's initiatives in the areas of autonomous technology and electric cars are being observed and may eventually pay off. Wood's investment in GM is encouraging for the business as well as the larger auto sector. It suggests that established automakers can change with the times and still be competitive, particularly in fields like autonomous driving and electrified cars. It also emphasizes the possibility of cooperation between more recent creative businesses like Tesla and established automakers. The decision made by ARK Investment Management serves as a further reminder that stock market trading involves more than just identifying winners. It also requires being receptive to fresh ideas and viewpoints. When making investment selections, investors will need to be flexible and take a variety of things into account as the car sector develops further. Wood claims that rather than being a danger to the brand, Tesla's recent price reductions are a challenge for other automakers trying to stay competitive. Wood thinks that Tesla's cost leadership and battery technology are to blame for these price reductions, and that in order for other manufacturers to stay in the race and prevent losses, they too must adopt this technology. These price reductions are a calculated decision that will probably help Tesla standing in the market, not a show of weakness. Tesla will continue to grow its market share and reach as other automakers find it difficult to match its pricing. Apart from the advantages of dispersing fixed costs and bargaining better prices with suppliers, economies of scale can provide Tesla a commercial edge. By increasing the production of electric vehicles, the corporation may use price as a tool to draw in more customers and increase its market share. More sales volume may follow, which would enable Tesla to take advantage of even larger economies of scale and solidify its place in the market. Additionally, as Tesla's production volume rises, it will be able to allocate more funds to R&D in order to enhance its offerings and create fresh approaches. This might increase its competitive advantage even more and make it harder for rival automakers to overtake it. Regarding Tesla's latest price reductions, various Wall Street experts have differing opinions. They fear that these price cuts would negatively affect the company's profit margins and eventually damage its brand value. Certain observers contend that Tesla's brand is founded on the idea of exclusivity and luxury, which is vulnerable to being undermined by more affordable models. Critics also point out that rising supply chain and battery manufacturing expenses may limit Tesla's capacity to reduce prices going forward. Supporters of Tesla, however, contend that the business will be able to maintain its profits while lowering prices due to its cost leadership, advancements in battery technology, and economies of scale. Additionally, they think that by lowering prices, the business will be able to increase its market share and carry on innovating in the EV industry. It's true that traditional manufacturers have been hesitant to adopt new technologies, especially electric cars, and Wood believes this is one of the reasons they are having difficulties. As a pioneer in this field, Tesla has made significant investments in EV technology and created a line of premium, reasonably priced electric vehicles that are becoming more and more well-liked by drivers. On the other hand, a lot of established manufacturers have been reluctant to make EV investments and have kept their attention on gas-powered vehicles, which has put them at a disadvantage in the quickly changing automotive market. The intricate and highly capital-intensive structure of the automobile sector is one factor contributing to the delayed adoption of new technology. It can be challenging and costly for legacy automakers to adapt their business model to include new technologies because they have established ties with suppliers and dealerships. They might also be hesitant to purchase EVs because of worries about the high cost of battery technology and the dearth of infrastructure for charging EVs. However, legacy manufacturers are beginning to make larger investments in EV technology as customer demand for EVs grows. Numerous have declared intentions to introduce new electric vehicles and to gradually phase out automobiles that run on petrol in the upcoming years. Even if they might still need to catch up on innovation, legacy automakers are starting to understand how crucial it is to adopt new technology in order to remain competitive in the market. This is one more important element that Wood feels is a part of the problems legacy automakers are facing. Emerging firms in the sector like Tesla, Rivian, and Lucid Motors are heavily invested in and committed to creating electric cars. These businesses are upending the established auto industry and putting pressure on established manufacturers to change with the times. Legacy automakers must contend with new competitors as well as regulatory obstacles. Stricter emissions laws are being implemented by governments all around the world, which will make it more challenging for automakers to keep making gas-powered vehicles. Regulators are also urging more funding for electric vehicles, which will put additional pressure on established automakers that have been sluggish to adapt. Legacy automakers will need to make significant investments in new technology and modify their business plans to satisfy regulatory and customer demands in order to remain competitive in this rapidly changing market. If companies wish to stay relevant in the automobile business, they must make significant adjustments to their supply chain, manufacturing procedures, and marketing tactics. This concludes the video. Please hit the like and subscribe buttons if you enjoyed it. We'll see you in the future video. I'm grateful. Tell me if you require any additional help.